So without further delay, I'm going to pass the floor now to Assistant Professor Michael Anthropellos. Michael is an assistant professor in the Department of Banking and Financial Management at the University of Piraeus. And he's also having a quite wide professional experience serving in the investment committees of various occupational pensions. So, Michael.
Thank you, George. Thank you, George. Thank you all for attending this conference. And this is our third attempt. And we hope that everybody is going to enjoy this conference. We have in this session, the first session of today's conference, we have three really good speakers. And first one is Matti Lepala, who is the Secretary General and CEO of the Pension Europe, which is an organization that leads is leading voice for the funded pensions in Europe. It represents 25 European national pension fund associations and covers more than 100 million European citizens and more than 7 trillion of assets, euros of assets. Mr. Lepala is a member and was a chair of and vice chair of the Occupational Pension Stakeholder Group of IOPA, and he was also a member of the European Commission's high-level group of experts on pensions for the period of 2018 to 2019, and the chair of the World Pension Alliance during the same period. Before joining Pension Europe in 2011, Mr. Lepala worked for 11 years for the Finnish Pension Alliance in the European Union, and as for his academic background, he has a Master's of Laws and an Executive MBA in Insurance and Financial Services. The title of the talk is Occupational Pensions Challenges for Policymakers. Mr. Matti, should turn on your camera. The floor is yours. You have 15 minutes. I will let you know, but before giving the floor to Mr. Lepala, I would like to remind the audience that there's an option for questions for the speakers, not only for this section, but for the other that follow. There's this, you can actually put your questions, place your questions in the choice of the chat in the Zoom. And Mr. Lepala, you have the floor. Can you hear me?
Yes, Michael, I can hear you. Now I hope I can. I can't share my video now.
Yeah, and you should also turn on your camera. Turn on your camera.
Yes, that's what I'm trying to do. So now it's enabled.
Yes, great.
So thank you, Michael, and good afternoon, everyone. So I have some presentation I'd like to share. I hope you can see it.
We can actually see it, yeah.
Okay, and then I have to find the right button to open it, actually. Here it is. Yep.
Yeah.
Right. Good. So I'm going to talk about some general challenges. I think Bill started on some of those, and I recognized 4 broad challenges that I would like to cover that are important for policymakers, especially in Europe. So starting with the first challenge, the structure of the pension systems means that the competencies are actually very divided. So all European countries rely on the first pillar, statutory social security pensions, but that's really the competence of the member states. That's part of their social security. It's tax-based or pay-as-you-go, and really not the business of the European Union, not really part of the internal market. Can be partially funded, often is not. Then we have the second pillar, occupational pensions based on collective agreements, often not necessarily, but often can be voluntary, can be quasi-mandatory, like the Dutch system. And then we have the third pillar, private personal pension products, which are then provided by various providers, insurance companies, banks, pension funds. And in addition, we still have this first pillar, BIS tier, which is funded part of Social Security, especially in Central Eastern European countries. So we have pension systems starting with taxpayer, Social Security, all the way to actually savings products sold in the market. And that means that the competencies are divided, and it's difficult to come up with a general pension policy. Also, it's important to note that you have different policy objectives, and thus you have different measures in different pension systems. So you can have as policy objectives various things: poverty relief, redistribution, intergenerational equity, all the way to having high coverage. And then you have different types of pensions to consider, all the way from public non-contributory all the way to private funded voluntary. And basically, you need to know what is your policy objective to decide what is your policy measure, and with what kind of a pension can you deal with that. So there's not one measure that can fit many objectives, and not all pension types of pension can fit the policy objectives that are important for you. When we look at the coverage of funded pensions in Europe, it's very diverse, with personal pensions in Sweden covering everybody, all the way that's in here in the bottom, with Greece with funded pensions, also Spain, Portugal, very low levels of funded pensions in different forms: personal, mandatory, quasi-mandatory, occupational. Very different picture from country to country. Also statistics very different, whether they come from the OECD or from European Union. But all in all, the picture is really diverse as funded pensions are concerned. Some have them, some don't have them. Very political issues, whether you should or you should not have them, and how you manage them. So there's no one-size-fits-all solution in Europe. In the Northern Europe, you have the highest coverage of occupational pensions based on either legislation or collective agreements, so quasi-mandatory, like in the Netherlands, which is the biggest of the pension fund countries in the euro area. In countries like UK, mandatory or quasi-mandatory hasn't been a policy option, so they have had good success with the auto-enrollment that they started in 2012. This has been a good experiment this far in the UK, or good experience increasing the coverage of occupational pensions in the UK. Many millions have been enrolled that were not before, and this is part of the European Union capital markets plan, and the idea is to see whether this policy option could work in other countries. And there are some countries already now, Lithuania, Slovakia mentioned here, that have started with auto-enrollment. In Western European member states, there are many countries which have voluntary occupational pensions, company or sectoral level, based on collective agreements, and some of them have reached high coverage rates, over 50% of the labor force. And some, like Germany, are preparing reforms to increase the role of occupational pensions. But in the Southern European member states, there's really still a lot of reliance on public pensions, and a very few have occupational pensions. And as a consequence of the need to have funded pensions, countries like Spain and Italy are planning to increase occupational pensions. In most Central and Eastern European member states, the occupational pensions have been marginal or even non-existent, like in the Czech Republic. None have been in place. But still, with all the challenges in the CEE region, there have been some positive developments lately. A lot of challenges, but still pensions that have been created during the last 10-15 years have been able to continue. Regulation has a big impact on pensions. We have the European Pension Fund Directive that has been implemented now in member states. It increased the administrative burdens and costs quite tremendously. And we see that for companies to be able to provide occupational pensions through IFFRs, institutions of occupational retirement provision, so the European pension funds under this directive, more proportionality is needed, and member states should not increase the burden with additional requirements. One problem with regulation is that pension funds are increasingly in the scope of European Union horizontal legislation. Here mentioned Digital Operational Resilience Act, a lot of new requirements. Sustainable finance puts a lot of requirements on pension funds and their investments. And it's important that the specificities of pension funds are considered in these regulations as well. There's a pan-European personal pension product that was launched last year. It hasn't worked in practice. There are issues with fee caps, and other changes are also needed in the regulation for it to pick up and to be a real viable product in the European pension market, in personal pensions. And pension funds are often in scope of various financial market legislations. And of course, from the occupational pensions point of view, it's important to see that occupational pensions are not products. They are more often results of social contracts and run by social institutions, and that specificity needs to be considered. The second challenge is the impact of crises. So after the great financial crisis, there's a lot of changes in pension funds, in pension industry. What will be the impact of COVID-19 and the war in Ukraine, still to be seen. Of course, the economic downturn is something that we experience already and has an impact. The shift from DB to DC and hybrid schemes is really strong and continues. When the Dutch are changing into their collective DC in a couple of years' time, most of the European pension funds will be in DC. At the moment, still close to 80% of the funds are in DB, but that is changing really rapidly. So this is shifting risks to members and beneficiaries. And in some countries, there have been reversals of reforms, especially in the Central Eastern European countries, but also in some other countries. So those developments are also related to the recent crises. And then, of course, this policy measure that has been used, auto-enrollment in various countries, it'll be interesting to see what will be the impact of the present high inflation, economic downturn, and lower returns. Do people enroll? Do they stay? Do they continue to save? It is crucial. Risks are shifting much more towards DC, but there's, for example, the Dutch are going from DB to DC, they are not going to a pure individual defined contribution, they're going to a collective DC. So there's still risk sharing and collective investments. But all in all, this trend from shifting the risks from employer to employee has been strong, and it continues. And of course, when the risks are more with the individuals, it's important how do they manage these risks, and if and when these risks materialize, what will be the consequences. One important development at the moment is the fact that because of various consequences, the interest rates have increased, and of course the financial market returns have been much lower in 2022 than they were in 2021 and previous years. But for the funding issue, it's interesting to note that when the value of the assets has decreased, the value of the liabilities, if and when discounted with risk-free interest rates, have deteriorated or decreased even more. And in countries where this is used, where interest rates are used as discount rates, like in the Netherlands, it has meant that the funding levels have increased and are much, much higher than they were during those years when the returns were actually very good, but the value of the liabilities was increasing because of the very low interest rates. So in this situation in 2022, it was possible to improve pensions in payment in countries like the Netherlands. The third challenge is the changing labor markets. So social protection and pension systems have, one could say, traditionally in many countries, if not most, geared primarily to full-time workers in permanent employment conditions or stable employment conditions, and of course that world is really changing. The real world, that around 40% of jobs in the EU are self-employed or other than permanent full-time work, and all these new forms of work like platform work or platform-based work is really changing the labor market, and the pension systems really traditionally have not considered these. So many people are outside the scope of the existing pension funds and occupational pensions, and thus this means that there will be gaps in terms of coverage or access to pensions and benefits. And that is, of course, a huge issue and needs to be solved going forward, and quite quickly. And the fourth and the last challenge I wanted to mention here is the pension gender gap. And in Europe, it is big. It's much bigger than the gender pay gap. On average, the gender gap is 30%, but there's great variation. So from Luxembourg's 43 down to Estonia's 1% difference, and this is of course a very big issue, and it's on the agenda of European Union to look at this. And again, here the policy measures are difficult because in many ways this is a result of the gender pay gap. And not, from that perspective, not a pension issue, but of course the consequence is that the pensions are not very equal, or that the gap is very substantial. And then with what kind of policy measures can this be dealt with? These were the general remarks I wanted to make on these policy challenges and the problems faced with the policymakers in relation to occupational and other pensions. Thank you.
Thank you, Mr. Lepala, for these wonderful points and the fact that you respected the time. We go on with the second speaker, and before that, I just want to remind the audience that there's this question option for the audience. You can actually place your questions using the chat choice in Zoom. The next speaker is Dr. Alistair Byrne, who is a Manager Director and Head of Retirement Strategy and UK Distribution at State Street Global Advisors. He leads the State Street's UK institutional distribution team, and he's also responsible for the investment proposition for major pension markets in Europe. He's very well known for his work in pensions in general, for both DB and DC pension plans. He publishes research, speaks at several conferences, and has been he has been quoted several times in press. He's also a PhD in the university. He has a PhD from the University of Strathclyde, and today he's going to present some results of a survey that State Street Global Advisor had done. So the floor is yours for about 15 minutes.
Okay, thank you very much. Yeah, we know that around the world we're moving from defined benefit to defined contribution pensions. Bill's referenced that, Matty has referenced that, and we know also that has put decisions into the hands of the savers. I think Bill referenced a kind of a wing and a prayer in terms of the pension promise, but we know there's a risk transfer, there's a decision-making transfer, and at State Street, our perspective on that is we really need to know, what the challenges are of those participants. We need to know what those participants are thinking as we design the system for them, as we design the investment strategies. And that's even more so the case with the pandemic, because the pandemic has resulted in a major shift in people's aspirations. It's resulted in changing working patterns, and we need to think about what that means for retirement systems. So the next few minutes, we'll look at the State Street's Global Retirement Survey, where we try to understand the issues faced by participants. And that's a survey that covers 3,500 defined contribution savers in key DC markets around the world. And those are the United States, the United Kingdom, Ireland, and Australia. Not yet the Netherlands. They're on that transition, but that is something that we'll look at in due course. My first question, and the first aspect of that survey, what actually is retirement? What are we planning for? On the right-hand side of that chart, and the kind of dark color and the lighter blue, you've got about 60% of people have what I would describe as a conventional aspiration for retirement. They think at one point they will completely stop work, and they will need some kind of retirement income to replace their labour income at that point. And the chart splits between people who think they're well on track for that and people who think that's what they want to do, but they still need to look at how they will finance that. On the left-hand side of the chart, a balance of people who expect to keep working in some form, and we find people who want to keep working, who think that I will work part-time, I will do less, but I still want to be in the labour market in my older years. A balance of people who just think I'm going to have to keep working, the 10% who say that they can't imagine being financially secure enough to give up work, and a cohort of people, 5% at the top there, who just want to keep going, that they get sense of purpose from work, and they want to keep going. So quite a lot of challenge to the conventional model of a cliff edge retirement. You get to 65, you stop working, you get your pension. An increasing proportion of people, that's not what they want to do. And as I said at the start, I think that the pandemic is starting to have impacts on that as well, and it's changing the way that we work. It's changing the way that we retire. And there's a lot of words on these slides. You might not be able to read it all at the moment, but essentially a number of people that we spoke to saying, I'm thinking about my work-life balance differently. I got wider priorities than just work. I might work less. Might work more flexibly. Some people thinking about, well, now that I've seen the issues raised by the pandemic, I don't want to work full time anymore. I want to start to enjoy my retirement, but I will still continue in the labour force on a part-time basis to do that. And the pandemic and all of the remote working that's come with it has given new opportunities. So the final quote, someone said, the 9 to 5 in the office isn't the model anymore. I've got more flexibility. I can work anywhere. So they can have the benefits of enjoying their retirement, traveling, whatever, not having to commute, but they can still be engaged in the labour force. So quite a lot of changes in the system. We need to think about the flexibilities that we build into the retirement system just to support these different work-life practices. The key metric in our survey, the headline metric, is about confidence, and it's essentially confidence that you will be financially prepared for retirement, that you will have the necessary resources when you come to that point in time that you want to retire. Generally speaking, optimism and confidence is quite low. You can see the dark line across the bottom. Less than 20% of people describing themselves as optimistic or very optimistic about their retirement prospects. 52% in the most recent survey saying that they're not optimistic. It's quite stable as well. We thought the pandemic might have some impacts on this. The cost of living crisis could have some impacts on it, and in practice, it's pretty stable. It's more to do with fundamental factors than anything kind of transitory in the economy. Cross-sectionally, We don't find that much difference across our different countries. There is an element that in the US and in Australia, as you can see from the blue coloured bars, there is a higher proportion of people who are optimistic. It's still a small proportion, it's still a minority, but it is notably higher than in the UK and Ireland. And as we search for an explanation of that, the US and Australia are both, if you like, maturer DC markets, that DC has been part of the system for a longer time. So perhaps in that respect, people have got more comfortable with the system, more familiar with the system, and that has resulted in a higher proportion having some confidence in their retirement prospects. We look at drivers of confidence, and again, this might be a bit busy slide on your screen, but to call it a few things, there are some transient factors that come through. So back in 2020, there's 28% of people were citing the COVID pandemic as a reason for reduced confidence. More recently in the sample, you get 69% describing the cost of living crisis and the high inflation as being something that they were worried about. But the other factors are more enduring, and the ones that I'm quite interested in are in the middle of that slide, where the lack of trust in retirement savings or the complexity of retirement savings. And I think these are long-standing and enduring issues, and they're really the ones that we need to work on. We need to build trust. We need to build, increase the simplicity, the intuitiveness of our retirement system. One of the things we look at in the survey is what people are doing, and obviously a crucial driver in retirement saving is how much are you paying in, what are your contributions, and we see from this part of the survey in the light blue at the bottom, most people don't make any changes. You ask them, have you changed your savings rates? The answer is typically no, which means we have to think about default rates. We need to think about the standard rates that we have people saving at. A proportion of people back in 2020 said that they'd reduced their savings in the light of the pandemic. That was less noticeable for retirement savings. It was more noticeable for short-term discretionary savings. And more recently, we've seen an uptick in a number of people that say that they've increased their savings rates. And that's surprising somewhat in the light of the cost of living crisis. I think that might be something of a lagging indicator that they have increased their savings. And then more recently, there has been inflation shocks, and they have potentially they won't be doing more of that. We ask about behavior more generally. What are people doing? Have you switched your investments? Have you switched your provider? Have you sought advice? Inertia is strong in the pensions market amongst DC members. By and large, they've not done any of those things. They've just run with the defaults. And again, we need to think, how are we defaulting people? How are we structuring plans? Because we can't rely on individuals to be particularly active in their decision making. The main thing that we found through the pandemic and through the recent volatility was people saying that they check their balance more regularly. They're aware of this volatility. They're interested in what's going on, but they're not necessarily making changes. And to the extent that relates to investment changes, that's probably a good thing, because a lot of evidence that people can make knee-jerk investment changes and regret it afterwards. So that's the core part of our survey. I want to finish up with a couple of topical issues. The first one is about retirement income, how you draw down your pension plan. And then the second one is about ESG, or sustainable investment. And one of the biggest challenges in pensions, actually one of the biggest challenges in finance, is how do you make your pension assets last for a lifetime? How do you manage the investment risk? How do you manage the interest rate risk? And particularly, how do you manage the longevity risk that you don't actually know how long you need to make your savings last for? It's a really, really kind of serious and challenging problem. And we want to understand what we can do to make things better for the participants. We find fairly balanced priorities or worries. People are worried about having the flexibility to cover unexpected costs in retirement in the dark bar. They're worried about having a consistent and stable income, which is the green, and they're worried about running out of money before they die. And you can see that the patterns are broadly consistent across the markets. The bequest motive is relatively limited, that those other challenges are much more salient than the idea that you might leave something behind for your children or other family members. So pretty balanced set of preferences. In terms of how people want to access their assets, we ask, do you want complete flexibility? Do you just want a pot of money that you can dip into? Or at the opposite end, do you want a stable income that lasts for life, even if that means less flexibility, which in the technical jargon would essentially mean converting to an annuity? The most popular option is somewhere in the middle, to have both flexibility and security of lifetime income. And to us, that probably means some kind of structure where someone in the early years of retirement has flexible drawdown. They can tap into their assets as and when they want. And then at an advanced age, which might be 75, might be 80, there's some kind of annuity income paid out, and that might have been purchased earlier in life in the form of a deferred annuity. So I think, areas where we need to innovate, we've got more work to do. Retirement income is clearly one of those. And just to kind of finish it up with the other topical area, ESG, sustainable investing. I'm surprised it hasn't really been mentioned already in the session. It is of interest to participants. They want to know their income, that the retirement assets are managed sustainably. So about half of participants say that they're interested in sustainable investing. They reject the idea that they don't care about that. The important thing is that they don't necessarily want to do it themselves. So if you ask them, do you want to pick the issues? Predominantly they say no. If you ask them, do you expect sustainable investing to be done as a matter of course with your retirement assets, then a majority of people say that's what they expect. So ESG is standard. And again, something for us to think about as we design investment strategies, that those defaults and DC plans should really integrate ESG considerations. Many do, but there's probably more work to be done. So that is a whistle-stop tour of our retirement survey. There is a report on it, and I'm very happy to get the conference organisers to send that round if it would be of interest. But I will stop it there and hopefully keep us on track.
Thank you. Thank you, Dr. Byrne, for this nice talk and very, very interesting results of the survey. I have to clarify the way that the audience can submit questions. There's no chat choice. There is this link with the label Ask, so you can actually put your questions there from your using the link that Mrs. Trapalis sent you. So we, without any further delay, we'll go to the last talk of this session. We're really pleased to welcome Dr. Maria Vassalou as a speaker to this session. Dr. Maria Vassalou is a co-chief investment officer of multi-asset solutions within Goldman Sachs Asset Management, where she manages group-wide investment policies, research in investment resources. She's also an IFFR fellow, professional fellow, and before her a really impressive career in asset management, she was in academics. She was an assistant professor of finance at the Columbia Business School and served as a president of European Financial Associations. Her talk today is titled Market and Macro Outlook, Effects to Asset Management Industry and Pension Schemes. Thank you so much. Dr. Vassalou, you have the floor for about 15 minutes.
Thank you very much. Can you all hear me well? I hope you can hear me. I won't have any slides to share, but thank you very much for having me in your program. I would talk a little bit about the outlook and how we see the world evolving at this point. So obviously the main issue is growth and inflation. We've seen this being the preoccupation for the past 1 or 2 years, central banks have started raising interest rates quite significantly, especially in the Fed, but also ECB and Bank of England are following suit. The issue with inflation is that while initially we thought it was transitory, it has become entrenched in the core and really gone beyond items that involve commodities and energy more broadly. So in order to be able to bring down inflation, we see an effort to raise interest rates. Obviously, the data we've seen recently, especially in the US, suggests that inflation is coming down, but it's coming down from elevated levels. And the question is whether it will go back to its target rate of 2%, or whether it will go down, but still settle at a level that is much higher than what the Fed hopes to achieve. So the question is, will it really go down to 2%, or will it stay around 3.5%? And then what? Will the Fed continue to raise interest rates to bring it down to 2%, or will they move their target to a higher rate? Now, this is particularly important because the 2% level is not a very scientific level, but it's an empirical level that was agreed among central bankers as the inflation rate that is supportive of economic growth without allowing the economy to overheat. But when this rate was defined, the world looked very different than it does now. That was during the time of increased globalization, the time of increased technological advancements, and therefore all these things were highly deflationary. And actually, if we look back at the period post the financial crisis, what we saw was that most central banks had a really tough time achieving their 2% inflation because globalization was so deflationary, as was all these technological advancements, the web, the online services, and so on. But since the pandemic, what we saw was a reversal in this globalization process. We also saw that when markets shut down and economies shut down, inflation shot up. So clearly there is a big relationship between the degree of globalization and the level of inflation that results in markets. Also, what the pandemic showed was the high level of interdependency of economies and the resulting vulnerabilities of these economies. And so the question is, should the economies be so interdependent that if there is a shock in one economy, all others suffer? Or should they build some level of resilience to protect themselves from external shocks? So all this process have started a debate about restructuring of supply chains, a new industrial strategy for different economies, rethinking resourcing of different commodities and products or parts. That was actually intensified during the after the invasion of Ukraine by Russia. We clearly saw a big shock in the energy markets, but also in other commodity markets, because people focus on the energy side, and suddenly Russia is a big producer of energy, especially and a supplier, especially in Europe until this invasion. but they're also producers of other important commodities, both in the metals side and agricultural side. So this process has led to a very high inflation shock globally that affected primarily Europe, but also other parts of the world. And so the discussion has been whether central banks can really deal with this shocks, or whether it's beyond their reach because they are really due to external shocks and not something related to their policy. However, what has become apparent over time is that as this increased prices of commodities persist, then inflation gets incorporated into investors and consumers' expectations. And so it does become entrenched. And so then it's something that central bankers need to do something about it to root it out, because once it becomes entrenched into expectations, it's very hard to bring it down. The Fed has been accused of being late in the process and therefore allowing inflation to be passed on from producers to consumers and consumers to build it into their expectations, demanding higher wages, which has led to this spiral of higher inflation and persistent inflation. So what the effort now is to break down this this vicious circle, and given the inflationary pressures that we see at different parts of the economy, the main focus of the Fed is really the labor market, whether they can actually bring down inflation there, and how this will be achieved. Clearly, when monetary authorities are restricting monetary policy by raising interest rates, reversing the quantitative easing and the purchases of assets that they have been doing since the financial crisis, that restricts financial conditions and has a negative effect on the markets, but also on the real economy. So economic growth is falling. We expect in the US, a big part of observers and economists expect the US to see a recession this year. The expectation is that recession will be mild. But nevertheless, we will see probably a recession. Some people maintain that we may escape that. We have seen in Europe that actually the worst scenario didn't materialize this year because the winter was milder. That allowed a reduced consumption of energy, and therefore that protected economic growth. The question is whether Europe has really avoided the problem altogether, or whether it has pushed the problem a year ahead. And that all depends on how they're going to, maintain their reserves of commodities going forward, and how well they will be able to continue diversifying their sources of energy, and what the other conditions, including the weather, is going to be next year. But really, all these things get reflected in the markets. The markets are a discounting mechanism of what happens in the real economy. And what we have seen is equity markets selling off. Last year, we had increased volatility. We saw a reversal of correlations among major asset classes, with equities and bonds moving in the same direction. And that certainly has had a profound effect on pension portfolios, because typically these portfolios, whether they're defined benefits or defined contribution funds, they follow typically a diversified portfolio approach, which means that they had in the portfolios a combination of equities and bonds and potentially other assets. Typically, when you have this kind of 60-40 allocations or variations to such allocations, the expectation is that there will be some downside protection, because typically in adverse scenarios, when markets risky assets sell off, bonds tend to do well because there is a flight to safety mechanism that leads to yields going down and therefore bond prices going up, providing some floor to those portfolios. Last year, despite the significant sell-off in equity markets, we didn't observe such a behavior. That was highly unusual. It did not mean that diversification in portfolios is dead, but it was really the result of, unlike other environments where economic growth slows down, and during those environments, central banks start reducing interest rates or doing other forms of accommodation. This time around, because inflation was so high, central banks started raising interest rates. So they started raising interest rates in a falling economic environment during a period of high inflation. And that's exactly what led to the positive correlation. Now, does this mean that this positive correlation is going to persist? No, because we already see signs that the inflation has peaked in most parts of the world, and it's coming down. So at some point, central banks will reach their peak rates. We think that in the US, it will be somewhere around 5% or a bit higher than that. And therefore they will bonds will continue to will start again to provide the diversification benefits to risky assets that they have traditionally enjoyed. So that does not mean that so the episode from last year does not really mean that diversification doesn't work. Bonds are not a good component of portfolios. It just was a very unusual year. What it has made apparent, however, is that a portfolio needs to be further diversified, and it's important for portfolios, especially those of pension plans, to include the other diversified strategies and uncorrelated strategies. And quite often those uncorrelated strategies tend to be in the alternatives business, whether they are hedge funds, whether they are private equity or other strategies that tend to have asymmetric payoffs and really protect the downside. So this is really the focus going forward. The other thing that is very important for pension plans and generally for portfolio management, given the current conditions, is that as interest rates have gone up and continue to rise, the ability to reach the target return levels of various central banks, various pension plans becomes easier, and therefore the need for leverage is going down. So in the US, for instance, a lot of pension plans have a target return of 6.5% or so, with interest rates with the riskless rate around 4.5%. That and rising, that means that they don't need to take a huge amount of risk to get to that level of return. The other thing that the recent experience has shown is that we have experienced much higher volatility, and that partly has to do with the fact that interest rates are higher. So when you have higher inflation, higher interest rates, that translates to higher volatility. Higher volatility also means the need for lower leverage in portfolios and much stricter risk management. So there are a lot of things that have changed since the pandemic in the way we approach portfolio management and what is appropriate for portfolios of pension plans. During the years of financial repression, to some extent, the years when interest rates were zero, or in Europe even negative, the need for leverage was very high. And we have seen, for instance, with the experience of the UK pension plans, how that was almost catastrophic for those plans because of how much leverage they were employing. So there will be a revisiting of how we manage portfolios going forward. And certainly the need for diversification, for uncorrelated strategies, and for stricter risk management will become even more important. I will stop here and revert back to you. Thank you.
Thank you, Dr. Vassal. Thank you so much. I would like to thank all the speakers for this session. We have a couple of questions from the audience. And we're going to address as many as possible. We have around 10 minutes for that. There's a question for. Let's start with a question for Mr. Lepala. The question is the following: do you think that there should be a distinction in the way that the pension is taxed depending on whether it is paid as a cash lump sum or in annuity? In Greece, for instance, there is this such a discrimination about the pension system. There is this policy changing now in Greece that a big issue is the taxation, and it will be interesting to have your opinion about this. In a way, it should be taxed in annuity, should be taxed zero taxed. What is your view about taxation in DC pension plans?
Thanks, Michael. Good and difficult question, and as Alistair already alluded, this payout phase is one of the most difficult economic questions theoretically as well. And also one other important notion here is, as the question is, that it's in Greece like this, that taxes are, of course, a national issue. How pensions are taxed is up to the member states to decide. And there are big differences in how contributions are taxed, how investment returns are taxed, and how then the payout phase is taxed, and that differs in many ways. So there's no European answer as such. We have promoted an EET model so that it improves savings if the contributions are tax exempt, and it improves savings if the returns are tax exempt, and so you tax the final payout phase. That's I think the preferred option, but as I said, it's really up to the member states. And from the mobility point of view, a TEE system where you tax first and then the rest is exempt can also be better for the mobility of workers. So it really means it really differs, and it depends on what kind of outcomes you want to have and what you're driving for. Then within the country, I don't know. I would hope that people are treated equally. If you have different options, then that you don't have a worse situation if you opt for one payout phase than the other. But that's something that I really cannot give a better answer.
Yeah. It's a really tough question indeed. I have another tough question, I think, for Dr. Vassallou by Achilles Kotogiouris. The question is the following. We see that although labor market is very tight, there is no significant real wage increase. What are the chances of having at the same time during 2023 very good earnings for the S&P and at the same time decline in inflation? How Fed and markets will react?
Thank you for this question. Our expectations is that the earnings will go down into 2023. So we think there will be a resetting of earnings expectations going forward as the consumer gets weaker. We see, for instance, from a consumption perspective that although the savings rate had increased a lot during the pandemic, it has returned to actually below trend levels. And the consumers are currently tapping their credit lines and credit cards to support their consumption. At the same time, the wages have increased in nominal terms much more than traditionally. So they're around 5.5% nominal increases. Of course, in real terms, they still shrank. But as inflation comes down, even if it comes down to 3%, if the wages, which are, as you know, more sticky, if they stay increasing at those levels, then they will actually increase in real terms. And if we look at GDP, real GDP growth accounting, we see that the share of labor in real GDP has increased recently and since the pandemic back to 1990s levels. And so that certainly will lead into the profitability of companies and decreases the share of real GDP that goes to capital. So the Fed's effort is really to redress that. And the only way to do that is really by increasing unemployment. And that's why we see increased rates, which increase the cost of capital. It decreases the opportunities for, it decreases consumption, and therefore leads to increased layoffs and a loosening of the labor market. Now, the labor market appears so tight because the participation rate has gone down, and it's really at historically low levels. That's partly because the younger cohort has really dropped out to a large extent from the labor market. They're probably still trying to build the next Facebook in their dorm room. But also there has been an increase in structural unemployment for the older cohort.
Thank you. One short, is another question for Dr. Byrne. If you be able to answer shortly, because we are running out of time. The question is that the following is, in many cases, a little bit provocative. In many cases, occupational pensions are simply used for tax benefits only, and or in another way, the asset managers show the increased asset under management in their books. The welfare of pensioners may not be their main concern. What is your view of that? Please be a little bit short to your answer because we are running out of time.
I think it goes back to some of what Matti shared, the different types of pension incomes and promises people have. You've got the first pillar, the state pensions around the world. They're generally getting less kind of generous, and people rely more on private savings. So, we need to make that system efficient. We need to get the right levels of saving in. I think a lot of participants around the world do very well out of their private savings, but in often cases, coverage isn't high enough. Not enough people have private savings. Not enough people are paying in appropriate amounts. So that's what we need to work on. And, come back to my findings. To do that, we need to build trust. We need people to see that their savings are used well, there's transparency, and they get good outcomes.
Trust is a big issue indeed. So I would like to thank you all. We have some more questions. I'm sorry that we cannot really address them all. I would like to thank all speakers and the audience for this nice session. I will give the floor to George for the continuation of the conference.